Looking at the action in the markets today, is this the calm before the storm, or is this a scene setter for more resilient earnings than are currently expected?
Yeah, well, great to be with you. And like you said, the market has been pretty resilient here. But our view right now is that the market is starting to price in a lot of good news, and there's little margin for error. We're around 4150. If I stress test some of our assumptions, and let's just say I give this market overall the highest PE outside the pandemic of the last decade, that's about 18.5. And let's just say earnings for the next 12 months are where the consensus estimates are today are right, which we think they're too high. That brings you maybe slightly above 4,200. So in our view, the upside is likely, capped, somewhere from about 2 or 3%. Of course, positioning can get you a little bit above that. But as we get into earnings, we think that the market is going to start settling. And again, from our standpoint, folks that overweight risk at this point, we would be paring back into the earnings season.
Okay. And the S&P today finishing the day at 4147, up about 1.4%. Amy, you're head of derivatives strategy. When it comes to options, the action we see in options can be very telling in the near term about market moves. What are you seeing where the banks and financials more broadly are concerned ahead of those earnings coming out tomorrow?
Yeah, that's exactly right. It feels a little calm before the storm because you have a VIX at a sub 20, but the reality is there's a lot of options activity right now playing out in financials. And you know what I think is interesting? It's all quite bullish. So you're seeing a lot of pre-positioning in KRE, the regional banks ETF, as well as XLF, the larger cap financials ETF, and all that positioning tends to be leaning more toward the call side right now.
So Keith, this is weird. Just bottom line for me, what should investors at home do in this situation where, what the market is doing valuation-wise and even directionally today could seem a little bit out of sync with what the Fed economists were saying yesterday about a recession and all the uncertainty we have heading into earnings season?
No, it's a good point. And, I think if you think about the last month, and if we were on a month ago and we said there's going to be some bank stress in the system, we probably would discuss it more, how much is the market down, not if it's down or up. So instead, the market's been, really resilient. But I think partly what's happened is the market is looking at what's happened over the last month as bringing the end of the Fed cycle closer. And around the Fed pause, you typically get some type of rally. But from our perspective, we just think that the risk reward is not that great. So again, everyone's different on an individual basis, but in our portfolios, what we would be doing, or what we are doing right now, is we have an overweight to fixed income and cash. We still have equities, but we're below long-term targets. And we would be patient to be, one of our themes this year is to be tactical, to be defensive. At some point, we'd like to go on offense. But again, if we had a more compelling opportunity, or if this market instead just kind of chops along here and moves sideways, that's just unexciting in our view.